stocks that can double series. Stock number one, it's Elf Beauty. I've done a video about Elf Beauty in the past where I have covered its business model, valuation, and also the financials. So I'm going to keep this video brief. At the time I recorded my previous video about Elf, it was trading at about $165, so I did not like that valuation. And in that video I said I will buy it if it's under $130. It's currently at $111. So that's why I'm buying, and I think it's going to double in the coming 2 to 5 years. Now I'm going to cover the 5 things that I look in a stock before I invest in it. The first one is the value proposition. Elf has a good value proposition because they are offering quality ingredients in a makeup for reasonable prices. So you don't need to go to the expensive brands to get that quality ingredient. So that's their unique value proposition. So that is a check. And number 2 that I look for are profit margins. Elf has 70% gross margins, and similar companies are achieving 10% net profit margins. So Elf is actually having efficient marketing, the social media marketing. Of course, they're also in stores like Target and Walmart, but I'm confident that they can get to high teens profit margins. So I like the gross margin and the expected net profit margin. So that is a check. The third thing that I look at is balance sheet. For the case of Elf, it's not great. At the same time, it's not too bad, and it passes my criteria. So it currently has $109 million of cash and $159 million of long-term debt, which they have to pay years later. And Elf is already profitable, right? So that's not a concern for me. There's no huge debt problem for Elf. And number 4 that I look for is growth potential. Elf was growing much faster, like 50% plus in the past few quarters, but all of a sudden they said for this year they can only grow between 25 to 27%, and that freaked out investors and the stock fell. But in my opinion, they can reaccelerate or at least maintain that growth rate in the next 4 to 5 years because they're doing international expansion. They are expanding themselves in Germany, Mexico, and Australia. So there are more countries to come where they can expand and increase that revenue. And Elf stands for eyes, lips, and face, right? But they're also acquiring a skin company called Naturium, and currently their market share is only 1%, and skincare is also a huge sector. So they can also increase their penetration in skincare sector and also get that revenue up. So because of these reasons, I feel like the growth is going to continue in the 20% plus range. But in the valuation, I'm going to take something conservative. So I'm not worried about growth potential. They have unique value proposition, right? So they should be able to take market share from other existing players when they expand to those countries. And finally, I look at the valuation. Previously, when I said it was at $165, I did not like its valuation. I thought it's too expensive and the stock has run too far. But currently at $111, it has a price to sales of about 6, and also the forward PE of about 31. So that's not unreasonable for a company that's growing in 25% range and also has good gross margins and is already profitable, right? So these 5 checks, the value proposition, margins, balance sheet, growth potential, and valuation, all these 5 factors are a check. And I feel Elf is going to double, and here are my assumptions. So as you can see on the screen, for the fiscal 2025, they're saying they can get to $1.28 billion of revenue. I'm assuming 20% growth rate for the next 5 years. With that, they can make close to $3 billion of revenue in 2028, by the end of 2028. And with a net profit margin of 17.5%, I'm assuming that they can get $500 million of net income. I'm applying a multiple of 30. I think people are going to pay a bit more. But with a multiple of 30, they would be worth about $15 billion market cap in 2028. And currently the number of outstanding shares are about 58 million, but I'm thinking that they're going to dilute the shareholders further because they offer stock-based compensation. They have cash on their balance sheet, they are profitable, they don't need to dilute the shareholders, but they are doing the dilution, right? So that's why I assumed 3% dilution year over year for the next 5 years. And with that, the stock price in 2028 would be about $230. Currently they're at $110, right? So that's going to be a double in 5 years, and this is with reasonable assumptions. In full disclosure, I do own 25 Elf shares at an average cost of about $111, and this is not financial advice. I'm not qualified to give financial advice. I'm simply recording my thoughts. So please do not follow me into this trade. Please take your own decision. To conclude, I'm going to give two risks that I think are going to jeopardize the gains for Elf Beauty. Number one is 80% of their manufacturing is in China, and if there are more tariffs implemented by other countries, that's going to increase the price, and that's their unique value proposition, right? They are giving quality ingredients at reasonable prices, so that's going to go away if the tariffs are increasing. They're reducing their footprint in China, but 80% is still huge. And the second risk that I think about is the premium brands like L'Oreal, Maybelline, etc. If they can come up with a budget brand with equally quality ingredients of Elf, then that's going to jeopardize Elf's speed or growth, right? So that's another risk that I see, but I don't think they're going to come up with any sub brand like that, but that is a risk that I have to count. Let me know your thoughts in the comments. Thank you so much for watching.